Hey guys, David Robinson here. Welcome to another episode of the Lead Sponsor Podcast. Really excited about our episode today. We've got a gentleman coming on that has a background as an attorney. He worked as in-house counsel for investment banks, and he started investing personally about 10 years ago, and all with the goal of replacing his W-2 income as an attorney. And he started out investing. His very first deal was actually a 20 unit apartment deal in a very remote area of Vermont. And it was a high cap, really deep value add play. And then he started to buy small multi, generally speaking, and built up a portfolio over the next roughly 8 years of around 100 units, was able to get to a place where he had replaced his income and then decided to start to scale his business. And he went from, being based in the Northeast in New York and investing within, a few hours drive of his base to going completely on the other side of the country and investing and focusing in Colorado, and how he was able to find his first larger commercial multifamily deal, a 54 unit in Colorado, through some strategic partnerships, and how he's able to successfully take down that deal, and how he's used both equity from family and friends, and also started to make relationships with more institutional quality funds and family offices that have been able to provide the equity to help him scale his business from roughly 100 units of his own personal portfolio to now 600 units in a matter of roughly 24 months. So really excited to have Michael Gilman with me today. My conversation was enjoyable. I felt like he had some real nuts and bolts insight and tactics and strategies to share with you as listeners about some of the things he implements from an asset management perspective, from a property management perspective, from the key relationships that he's built, and being able to take down deals thousands of miles away across the country while he's based out of New York. So I hope you enjoy our conversation today. Without further ado, Mr. Michael Gilman. Mr. Michael Gilman, welcome to the show. I appreciate you coming on the Lead Sponsor Podcast and chatting with us for a bit.
Yeah, thanks for having me on. Excited to be here.
Yeah, my pleasure. So just to get us started, tell us a little bit about your background and how you got into the real estate space.
Yeah, sure. So actually started my career as an attorney, which was always investment minded, and specifically started in-house at investment banks and supporting various business lines, like Wall Street investment banks. Looked around asset classes, was looking for something to invest in over the long term, build wealth, eventually get out of having a W-2 and the goal of being an investor full time, and kind of settled on real estate. Concluded just after seeing the dot-com bust, and then where my parents lost a bunch of money, and then seeing the meltdown in 2009, which is when I started my career on the street there, seeing how volatile the markets could be. It seemed like real estate, combined with the sort of really good tax benefits you get there, and ability to transfer wealth relatively easily, were just seemed to outweigh every other asset class. So kind of started there, and was just looking around for deals. At the time I had a full-time job, so I wanted something with really high cash flow. I thought maybe I'd just build up a really high cash flow portfolio, replace my salary. And that's kind of how I started. And then I was kind of looking every day, had search filters up, and in New England, and I thought it was important to be within driving distance, so kind of 3-4 hours max from New York. And then one day this property popped up. It was a 20 unit out in Vermont. It was penciled out really well to about a 10 cap, and I went to visit, and it seemed right, because especially I like going up to that region for recreational activities, skiing, what have you. So that's how I got started, and then just started buying up these high cap rate, high value add properties because each one was just a mom and pop owner. So there was always the opportunity to increase rents naturally. Lots of operational efficiencies, especially up in a colder region like Vermont, from mechanicals, energy efficiency, working with the state grants and stuff like that to upgrade energy systems to get your expenses down. So that's one of the big expenses up there is heating. So yeah, just got myself up to start approaching 100 units, and COVID hit, and the Fed load rates, and I felt like the time was right to expand markets. Colorado, Utah, those were markets I'd been monitoring for some time, and I could stop here and so I could
Yeah.
keep carrying on.
No,
But
I appreciate it. Let's
yeah,
actually
yeah,
let's actually move into, what your business looks like today and what you're focused on. I know you said you were approaching about 100 units as when COVID hit, and then you decided to expand. So today, we're recording this near the end of July 2022. What does your business focus on today? What markets are you interested in? What product type you're interested in, and what does the structure of your business look like?
yeah, absolutely. So right now we're really focused on Colorado Front Range, where we've partnered with my partner Phil, who runs the construction and property management, and we focus on heavy value add reposition stuff we could do from like a C to a B, something like that. Uh, all on the Front Range. We're at about we're 600 units on aggregate between markets, uh, and we're going to be at about north of 300 shortly in across the Front Range, and rapidly scaling from there.
Yeah, so that's a big move, right? In the last roughly 2 years, going from 100 units to 600 units, and investing literally on the other side of the country, from where you're based. So before I talk about sort of how you scaled up, I want to go back to when you first got started. Was that 20 unit in Vermont the first deal that you purchased?
Yeah, that was about 10 years ago. That was
Okay.
my first deal. Yeah.
And you were still working in your corporate career as an attorney for investment banks. Is that correct? When you bought that one?
Yeah. Yeah. I was kind of buying them at that point. And slowly, primarily because I was just using my own capital. And we'll get to that later. What accelerated my growth was pooling capital. But we can get to that. But anyway, I didn't want to jump in here.
No, yeah, that's fine. So, so that was your first, 20 unit was your first foray into investing. Many people start in the single family space. It sounds like you even sort of thought in your mind, hey, maybe this is, single family, maybe small multi, and then this 20 unit popped on your radar, and you went and acquired that. Did you end up, buying the 100 units over roughly an 8-year time horizon? What did those 100 units consist of? What did your portfolio consist of as of roughly 2020?
Yeah, it was all smaller multifamily buildings. That 20 unit was actually an outlier in the market. It was one of the larger buildings. I mean, this is like almost, you talk about tertiary markets, but this is a frontier market in many respects, at least where we do. We like to buy stuff, but it's also by really attractive places like ski mountains. And so we branched into short-term, rentals there, but that's a whole separate thing we can dive into. But anyway, just getting back to your question, it was all smaller multi-family, sixplexes, 10plexes. There were some that were headaches. I sold, but they all made money, even the headache. So Yeah, so essentially I just, cobbled them up slowly and kind of at one point stopped focusing on it because I did encounter a headache and it was just a management headache. One thing out there is you have to self-manage, at least really if you can do it properly. So it ended up being a good thing because it allowed us to scale. We built out our own self-management, our own construction. But for a time I stopped just because I was like, "Oh, I don't want to deal with this. It's too much of a headache." Uh, so that pause that lasted for maybe 2, 3 years. Um, and then eventually I really started going heavy again, as I was saying, when COVID hit,
Mm.
because I've seen that kind of cycle before, play out, and I knew there'd be a lot of asset inflation.
Yeah, and I'm interested in sort of your mindset around, buying the small multi. It's pretty common in the Northeast to focus on that small multi deep value add play. Is that were you also involved in fix and flip and wholesaling, or was it strictly working on your own projects that you were buying?
Yeah, it was really just working on my own projects and not really so much for fix and flip, just because I didn't have the time.
Mm.
These are you really have to oversee the execution, and the GC side of it has to, or your partner has to be, you know, partnered with you really.
Yeah, and then so I just want to make sure that I have the sort of the time horizon correct here. Roughly 10 years ago is when you first bought that 20 unit, which was a bit of an outlier, but mainly stayed in the small multifamily space for the next roughly 8 years up to 2020, where you decided, after accumulating a portfolio of roughly 100 units total in generally small multi, you decided, hey, you know what? 2020's hit. What was the mindset of, or I should say, COVID hit? What's the mindset that caused you to expand, both
Yeah,
geographically and asset type?
sure. So, at that point, I had cobbled together enough to kind of reach that initial goal of the salary replacement. It
Mm.
had taken longer, or it took what it took. But and I didn't really, as I said, there was a long period of time where I was like, wasn't sure that was the right thing. But anyway, I wanted to get into a bigger market. I wanted to get into. I also wanted to get into a market. I like to go visit. I'm over there a lot, shrimp skiing as well. So, and I specifically started with Colorado just from, fundamentals perspective, population, and obviously there's plenty of, a few states there that, would fill the same requirements. But I knew it'd be hard just coming in from New York, right? It's an insular market in a way. So I started. I found an off-market company called Offered, OFFERD, which they specialize in off-market acquisition. And so they built a kind of best-in-class database analytics of properties around the U.S. And then they kind of overlay their analysis on it. And so you say, I want every property where there's value add in Colorado, and they'll run that filter. And then you could what the amazing part, I think, is they have the arm that'll start not knocking on doors, but trying to get in contact with the owner, calling them, mailing them, putting them on their marketing loops, and just trying to source properties off market. So that was how we got our first property.
And that was in Colorado.
Yeah, in Denver. Yeah,
And what type of property was it?
it was a 54 unit. uh,
Because the offered is, I did not realize that they actually will help you target multi. They have a pretty heavy presence in the residential space and trying to identify or predict, using their predictive analytics to determine potential sellers, highly motivated sellers. But I didn't realize that they did that. So that's great. So that's OFFRD, just for anybody that's curious. Um, and so you identified this 54 unit. But did you what was the structure of your business at this point in time, right? I know you had the management headaches. So just to sort of bring all these pieces together in this transition point, this sort of inflection point where you decided to expand into a new market, go bigger. Um, you sold off any of your existing portfolio to sort of recapitalize and be able to make this transition? And then also from a partnership perspective, what did that look like? Was it still just you going after this on your own? I know that you mentioned you partnered with someone that has a construction background, but maybe just talk to us about this sort of inflection point, how you went about executing this transition to a new market and going bigger.
Yeah. So, I had sold some assets, but they were 1031s, and they were used to do more deals in actually those markets in New England. So, on the capital end, that's where we started pooling capital. So, on that deal in particular, so this company offered, again, OFFERD. It might be a little different than the residential company you spoke
Okay.
about. They only do multifamily acquisitions and uh, anything to do with that. But anyway, so they actually, when we found the asset, they actually offered to be a co-sponsor and
Mm.
help, help with the raise and help get the deal done, and help us just scale generally as an operating partner. So we, I was going to need help. So that was welcome. And so we, that was our first, pooled capital deal where it was essentially friends and family.
And this was 2020.
Yeah, we ended up closing in in in, um, January of 2022. Sorry, 2021.
21. Okay,
Yeah.
great. All right, so that was your first move into sort of a bigger asset type, also investing across the country. And I'm assuming you mentioned that this was a pretty deep value add play. Maybe just describe that deal for us, just high level.
Yeah, it was value add from the perspective of it was 1970s vintage. It was in a great neighborhood that was up and coming. There was Sloan's Lake, was around the Sloan's Lake area, right outside that Denver core. And that's what we were targeting. We, specifically from the, outflow out of the core to these first ring suburbs. So it was, and then the value add was, essentially the conversion to like a Class B asset, putting
Mm.
in quartz countertops, stainless steel package, lighting, flooring, um, and just getting rents to market at that new renovated premium, which was the spread was significant from our kind of data, and that certainly panned out. And then you had that the rent inflation hit, which certainly no one predicted, and that certainly didn't hurt.
Yeah, absolutely. And so I'm guessing just from an execution standpoint on this particular deal, clear across the country. Now you did, have the co-sponsor in place. Are they based out of the West, or did they have a footprint in Denver?
Yeah, no, so they're in Texas. They're actually out of Austin.
Okay.
They did not have a Colorado presence. So we went in with our, the plan was we had a property manager and they would do the construction. And so that's actually a good story because that didn't work out. It closed. All of a sudden the budget started changing. The timeline started changing. Only did one,
From the selected
executed at the
PM
speed.
from the property management
Yeah,
company you
yeah,
had selected. Hmm.
yeah. So we went to market and or called every GC we could find and got bids, and probably there were 1 through 10 bids at least. And me, this is where having done my own construction, knowing what things cost, what you could execute on, I knew what the budget should be. And There was actually only one person that came came at that budget, and that was Phil. This Phil at 3Gen. We ended up he ended up doing the construction, and then hit exceeded our projection on speed, and came
Mm.
in on budget, which was huge during an inflationary period. So that's, from there we were kind of, I was like, Phil, let's keep this going, and we were kind of off to the races in terms of doing more deals.
That's great. And so on this particular deal, did you bring in outside capital, outside equity on this deal?
Yeah, it was friends and family, and then we had a kind of high leverage bridge loan, about 85, I'd say 85 loan to cost.
Okay. And did you structure it as a syndication and you brought in passives or more of like a joint venture?
It was a syndication. It was passives. It was friends and family largely.
Okay, great.
Yeah.
So talk to us about, all right, so this is your first foray, and thank you for going into some detail about that deal, how you sourced it, sort of the business plan around it. And just to sort of put a bow on that project, Phil was a key component of the success of this project, right? You needed someone, boots on the ground, that would be able to, that understood the construction. You had the knowledge about construction. You've cut your teeth on deep value add deals in the Northeast and really understood that, correct?
Yeah, but right, I can barely replace a light bulb, as my wife would say.
Gotcha.
Right. Certainly, the key to the business is the execution. Without that, the plan wouldn't work. Right.
Yeah.
This is all based on pro forma projections, and so we're not buying Class A, at a 3% coupon or whatever. We got to put in some heavy work. So that's the key to it, right? You got to buy right, of course, but then you have to execute right.
And so having Phil, your partner, that will eventually, started working with you on a higher level, was he the key component to the success of that deal then? I mean, I'm assuming that he was the one boots on the ground, operating, overseeing the project, etc.
Yeah, certainly I'll give myself credit for picking the right asset at the right time, at the right
Sure.
price, the right location. But Phil, certainly, his ability to execute was what did it for us. Yep.
Yeah.
Took us
Okay.
to
So that was your first foray into raising outside equity, friends and family, that type of thing. I assume your first syndication deal then, if that was the first time raising equity.
right. Yep.
Okay. So you've scaled since then to roughly 600 units at this point. Talk to us about this growth trajectory in the last, roughly 18 months to go from 100 to 600 units, and really focusing on the syndication model as a way to grow.
Yeah, so from there we just started syndicating deals in both markets. We started doing portfolios in New England and Vermont in particular. Right after that, I was just fortunate enough to meet a portfolio seller on the ski mountain. I mean, quote unquote, that's where the deal was negotiated. But that got our next deal going. That was about a 50 unit. Then we followed that up with an even bigger portfolio in Vermont, which was about 150. And then at that time, we found another deal through Offered. It took a while to find the right deal. I mean, we had been underwriting ever since we closed that first deal, but it took about another year to find something with the same value add.
Mm.
And this was Edgewood, but the value there was different. It was a suburb called Westminster. This was 110 units, and some change there. But that it was like 70% occupied. There were some fire damage units. There was rent wasn't getting collected. Rent wasn't getting paid. It was kind of the bad looking building on the block.
So I gotta pause you right there. Like, what's it like, being across the country, knowing that you have to execute on a deep value add play, and not really being in proximity. I mean, I know you mentioned that you like to visit and be out here to ski and that type of thing, but what's your mentality around doing a deep value add deal that has all kinds of problems that need to be solved and being clear across the country? What are your thoughts?
Yeah, so I mean, first you have to be prepared not to be across the country, but that's number one. Besides checking on it, say quarterly, it's really your partner who you partnered with. And so going back to Phil, he's there on site. He's there multiple times a week. He's in the office. He has his own office. So he's there driving that and kind of going from project to project throughout the week. And
And
yeah,
yeah, go ahead. Sorry.
obviously he has his team and his you know construction manager, and it's also he's got family in it. It's a family business, which I like.
Mm.
So and then we're on Slack every day. We're talking every day. So that I think that really helps.
And so, have you guys formalized or put together a formal partnership, or is it more of a loose partnership where it's project specific?
Yeah, so it's actually a formal partnership now. And especially as we were scaling, we were noticing investors were asking about it in particular as you get to kind of family offices and funds and they start looking at incentives and is this built to last? That's where we kind of put it down on a partnership operating agreement level.
Yeah, makes sense. Okay. And you had mentioned, when we were chatting before that the asset management, the project management side of things is something that you really are passionate about. Talk to us about some strategies or tactics that our listeners could learn from you that you've implemented to help you manage these type of deep value add deals.
Sure. So I mean, it's you have to be plugged in. So kind of a daily basis down to the bank account level, right? So I'm looking at the bank account statements, making sure stuff's being spent where it's supposed to be. It's for us, we're integrated. So on the property side, we have our own company in New England. On the Colorado side, Phil, we use the same platform, property management frontware.
Okay.
So we're integrated there. So being able to get into that and just flow, it really flows from the property management to the asset management, right? The asset management kind of I see it as the analytics. So I have kind of my lieutenant Eugene, who he's got a quant kind of background, and he
Mm.
does the crunches the numbers and does the models, and that's his skill set. Mine is just that hands-on experience, kind of running the ship day to day from the property to this project getting done. We're doing a lot of subdivisions, just kind of all over the place, just jumping into each little thing going on.
And so, is there any particular, methodology that you've implemented that's helped you to stay on track with all these projects? Or is it just, hey, you come in, you see what fires are in front of you, and you put out those fires? What does that look like for
No, I don't like functioning like that. Actually, Phil likes to function like that, but I'm a task list guy. We use Trello. We have
you?
who's doing what. What KPIs. What's the due date? And so I wake up each morning. Actually, it's the first thing I review is the to-do list. Where are things? Who's doing what? Where do we need to switch like priorities and resources? What's running ahead? What's running behind? Kind of those judgments.
Yeah, love it. So, I want to sort of project forward here as we start to wind down our conversation. I want to project forward. What's on the horizon for you and your company? What do you guys want to accomplish in the coming years?
We really want to get to a comfortable scale in Colorado right now. That's where we're focusing. We've got some significant stuff in the pike coming down the pike. I don't want to jinx it, so I
Yeah.
won't mention it. But scaling there, getting to over 1,000 units, which we've done in a way that we've combined with Phil's side, and he has third party property management. But part of our partnership with Phil is he's exclusive to doing deals with us, and he kind of keeps that third party management side, but the actual deal making. So just getting to like a good scale, so, north of 1,000, I'd say, along the Colorado Front Range.
Love it. And what do you see as the biggest obstacle to you getting to that scale?
It's systems. We're working on an asset management dashboard and just trying to get everything to sync, and APIs and pull from our front end, and just being able to do it in a really systemic, uh, data driven way where I don't have to personally kind of oversee each aspect of everything.
And so, does that mean implementing some sort of software? Does that mean developing a software to help you manage the projects? What does that look like for you to overcome that obstacle of systematizing the entire process?
It's policies, procedures, and certainly automation on the systems end. Like, for example, we have to run custom queries from investors, or in underwriting, sometimes we'll have to do custom work on the model, right? And so I've got Eugene, and that could blow up his whole day, just kind of working in the weeds there on these models. So being able to just get it all from a front end, at least on the asset management side, um, and just it becomes much more of a business, right? So it's just like operating a business efficiently and with the right people.
Yeah. So, as we wind down here, I got a few final questions for you. The first is, what's something that you're just absolutely crushing right now in your business that we could all learn from?
Um, we like markets like some of these small market deals we do in New England and Vermont. They're just the cash flow is double digit north of that. And then we combine it with some short-term rentals, and that amps it up some more. So for us, it's having a blend of lower cap markets like Colorado, but also a higher cap markets. So I'd say diversifying in that way is appealing, especially as stuff is volume. So stuff's always changing.
Absolutely. And do you see that as a challenge in doing, small market deals that are completely different business plan than the more larger market deals, in a completely different location that sort of have a different mentality? Is that a challenge for you? Do you see it as something that may be hindering your growth to be able to scale in Colorado as you're having to take some focus away from that?
Yeah, that's a great question, and actually, that's something I've been thinking about. And ultimately, I am looking to kind of offload some of the smaller market stuff, uh, and to someone that's interested more to run it, and do their own deals and partner with us in some way using our infrastructure. But I kind of don't want to be involved in the underwriting. We're not going to be actively looking for deals so much. Something great comes along, sure, but definitely scaling down there in terms of my energy.
Yeah, but it's also probably been very helpful for you to be able to get to the place that you're at, right? Focusing on those high cash flow deals, replacing your W-2 income, allowing you to move full time into the space. I'm sure that's all played a role in you getting to the place that you're at today.
Yeah, I don't think I could have without it. It's certainly a good base, but it's like it'll only get you so far, at least in that type of market. And, especially as it's just when you look at sponsor fees and you apply them to these low kind of value deals, right? The economics aren't become less attractive. Like the deals could be super great, but a lot of it's not, 90% of it, of the stack is not of the equity stack is not our capital, right?
Mm-hmm.
So the actual net of, the fees become pretty important as well. And so we believe we can get, and we've shown we can get great deals in these lower cap rate markets. Just a different strategy. And
Yeah.
so it's a more appealing one from the sponsor's perspective, and especially because I'm not looking to be in the property management business. Like that's not a side of the business I'm personally interested in expanding too much. So
And I did have one question come to mind. You started out in bringing in family and friends, and you mentioned, this, we probably don't have time to go into great detail about, bringing on more of like an institutional equity partner, that type of thing. But what has that equity side looked like for you from that first deal we brought in family and friends to, now trying to scale at a higher level?
yeah, so on the next deal we did in Colorado was twice as big, and um, we got a few larger players in there from previous. One was an offered connection. One was my connection I had, and they wrote significant checks, but certainly smaller checks than they would write. Normally, it was a new sponsor relationship, so
Mm-hmm.
that was a huge one. Just getting them in on that our next kind of really big syndication. And then from there, I just actively started courting, that profile type, funds, family offices that
Mm.
will work with emerging sponsors and like value add deals in the region. And just establishing that relationship in advance of the next deal.
And how does one start to build relationships with funds, family offices that are, that is a newer sponsor and hasn't really established a full track record?
Yeah, so I think that's where having a good deal is great marketing. Like, a lot of people talk about like, the kind of day-to-day marketing, talking about cap rate or your business or this, that. Like, I think the really good marketing is you have a good deal. Like, yeah, you're going to raise capital. You need to raise capital for it, but also use that as an opportunity to get in front of people and just like say, and so if I have a good deal, and I can kind of don't have a way there in terms of a third party introduction. I'll just roll in through the front door, email the principal or usually email or LinkedIn sometimes.
And what, just for our listeners, like, I mean, what does that look like? Hey, I've got a deal. This is my track record. Like, I want to set up a call. What does that look like?
Yeah, kind of like, hey, took a look at, your info. Seemed like we target the types of deals you like to invest in. As a matter of fact, we have here's an example deal, and it's underway. I'm sure, it's just an example of our flow, right? Like people want flow, right? Like they might not invest, but they want to see deals, and so just demonstrating flow, and so essentially just a quick intro, and just as you said, here's a deck. The deck has our track record, some case studies. That's how we've done it in
Yeah,
terms of
love it.
this front door entry approach.
I like it. Well, very practical. Yeah, that's awesome. Just, hustling to find, investors that can help you achieve your goals. So that's great. All right. Second to last question. What's the biggest challenge that you're facing right now in your business that we could all learn from?
Um, it's it's like bookkeeping, I'd say. We've had to transition. We use a third party company. their main, our account or our bookkeeper who we worked with for so long left, and then the whole thing collapsed. Like I didn't
Mm,
realize we didn't have
that's tough.
real processes in place. Like they brought in a new one, but just nothing stuck. And so I had to like get involved. I don't like getting involved in that side of the business. Actually, it's funny because my first job, I was a bookkeeper. My dad's an accountant. I was like 13.
Mm.
I was doing bookkeeping entries in QuickBooks.
He ruined it for you.
So I'm like, just get involved. I'm like, we're on a call. I'm, I start the call. I'm like, I did this when I was 13. Like, why am I spending my time on this? And I don't even sound like an app. Like, it's just like, I tend to get frustrated sometimes. So it's like not getting frustrated and just being able to lead the team to where you need to get to, and just don't get frustrated.
Yeah, love it. Great advice. All right. Well, this has been a great conversation. I appreciate you allowing us to sort of jump around and talk about different aspects of your business, sort of hear about your story of some of the deals that you did early on, how you got into the bigger space in the 54 unit in Colorado, and how you've made connections with some institutional equity partners that have allowed you to scale from a 100 unit portfolio just roughly 18 to 24 months ago to now 600. And I know you've got a few deals in the pipeline, a few deals in the works right now, so you've got a lot headed in the right direction. Before I let you go, what's the best way for our listeners to connect with you and learn more about what you have going on?
Yeah, it's LinkedIn, just Mike Gilman, or our website, crossmountaincapital.com, or just emailing me, Mike at Cross Mountain Capital.
Awesome. So we have a link to Mike down in the show notes right now. So if you've enjoyed our conversation with Mike and you'd like to learn more about his business and connect with him and his team, go down in the show notes right now, click on that link, and connect there. Mike, a pleasure to have you come on the show. Thanks for sharing your journey with us, and I look forward to connecting with you again soon.
Yeah, thanks for having me. It was a pleasure.